Marginal revenue product is really a way of valuing a worker's contribution to the firm. And it's one of the most important valuations because from the employer's standpoint, it measures how much additional revenue that worker adds to the business. It's calculated as the marginal product times the marginal revenue. For example, if we have one worker, we hire one worker, and that worker has a marginal product of 5. Well, that means that worker added 5 units of output to our business. If the marginal revenue of each of those units of output is 200, then that worker's marginal revenue product is $1,000 because they produced 5 additional units of the good, and each of those units added 200 to revenue. Hence, 1,000 was added by that first worker. If we add a second worker, and that second worker has a marginal product of 4, meaning they added 4 units of output to our business, and the marginal revenue of each of those units of output is 200, then we have 4 times 200, which is 800. You can see that the marginal revenue product is decreasing or diminishing here. Well, of course it is, because the way it's calculated, we have a constant marginal revenue, but we have diminishing marginal product. Each of these workers from 1 to 7 adds output when they're hired, but at a decreasing, diminishing rate. So we would expect their marginal revenue product to decrease as well. Another way to think about marginal revenue product is because it's the additional revenue that that worker adds to the firm, it is the maximum that the firm would be willing to pay for that labor. If I hire this first worker and I see that worker's marginal revenue product is $1,000, then I would be willing to pay up to $1,000 to get that worker, because essentially that worker adds $1,000. So if I paid, let's say, $500, I would be getting $1,000 in revenue and giving up only $500 in labor costs. If I paid $900 in labor costs, then I would be getting $1,000 from that worker's efforts and only paying $900. I'd be better off by $100. So you can imagine this is a good way of determining whether a worker is employable or not. And it ties in with our diminishing returns. For example, let's say that there is a wage in the economy of $650. Well, would I hire the first worker? If I have to pay $650, but this worker adds $1,000 in marginal revenue product, I would want to employ them because I would have a profitable opportunity. I would bring in more revenue than wage costs. Would I hire the second worker? The second worker, I would pay $650 and get $800 in revenue added to my business. That would be a profitable employee. Will I hire the third worker? I wouldn't, because if I hired the third worker, I would have $650 in wages, but only $600 in marginal revenue product. I would be losing $50 off that worker. So my employment decision at a wage of $650 would be to hire 2, but not 3 workers. Now, if wages were to drop, maybe to $500, then I would find this third employee employable, but I wouldn't find the fourth. You see, a firm looks at the marginal revenue product of the worker and compares that to the wage they have to pay. And that helps them determine whether they should employ a worker or not, and ultimately how many workers do get employed in the business. A closely related concept to marginal revenue product is value of marginal product. They're very similar, but there is one important difference. With marginal revenue product, we take marginal revenue and multiply it by marginal product. Whereas with value of marginal product, we take the price of the good times the marginal product. For a perfectly competitive firm, you'll note that the price of the product is equal to the marginal revenue. They're the same thing, which means that the value of marginal product is identical to the marginal revenue product. So we really don't need to worry about this difference when we're dealing with a company operating in a perfectly competitive product market. But it will come up as an important distinction in more real-world kinds of markets. Before we talk about that, let's recognize that the firm considers the marginal revenue product of the worker and compares that to the wage, also known as the marginal wage cost. If the marginal revenue product is greater than or equal to the marginal wage cost, the worker is employable. If not, they're not employable. With that in mind, we can actually construct a labor demand curve for the firm. Remember, the demand curve for anything is always the maximum willingness to pay. So for example, this first worker here, the maximum the firm would be willing to pay is $1,000. Why? Because that's the worker's marginal revenue product. That first worker generates $1,000 in marginal revenue for the business. So the firm would be willing to pay up to that amount. Now, that doesn't mean they want to pay that. They would rather pay less than $1,000, but their highest bid, the most they would ever be willing to pay for that worker, is $1,000. For the second worker, the marginal revenue product is $800, and the demand, maximum willingness to pay, is $800. Continue on. Third worker, $600. Fourth worker, $400. Fifth worker, $300. Sixth worker, $200. And then finally, the seventh worker is $100. This downward slope in the demand curve exists because marginal revenue product is downward sloping, and they're the same thing. Why is marginal revenue product downward sloping? Because marginal product is downward sloping. Why is marginal product downward sloping? Because of diminishing returns. In essence, as this firm hires more workers, each worker is becoming less and less productive in marginal terms. They're getting in each other's way. It's a short-run function, so they're sharing capital, and the potential for each worker to be less productive increases in the short run. All right, let's now switch gears and go to a company, same one, but let's assume that they're operating in an imperfectly competitive market. In this environment, we got the same production function. The firm's workers and their capacity to produce total product and marginal product doesn't vary based on whether the product is sold in a perfectly or imperfectly competitive market. What is going to vary, though, is some of our other metrics. For example, in an imperfectly competitive market, the firm is going to be able to make the price. And what that means is they can choose the price. If they charge a higher price, they'll sell less units. If they charge a lower price, they'll sell more. So they face this lower price as they try to sell off more product. One of the important things to keep in mind is in an imperfectly competitive market, the firm is seeing a larger slice of demand because there are less competitors, all the way down to where there's none in a monopoly, in which case the firm would see the entire demand for that market. But in a highly competitive market, a perfectly competitive market, there's a lot of firms. And each firm is getting just a small sliver of the market. So from their perspective, they don't see a downward sloping demand curve for their product. They don't see this idea of having to lower the price to sell more units. Because from their standpoint, they can sell as many units as they want at the market price because there's such a small slice of the market. Okay, just keep that in mind so you understand the difference between perfectly competitive and imperfectly competitive product markets. But we have prices varying with total product. They have to lower the price to sell more. Total revenue is calculated the same way, price times quantity, so 200 times 5 is 1,000, 190 times 9 is 1,710, 180 times 12 is 2160, so on and so forth. Marginal revenue is calculated the same way. Remember from before, marginal revenue is the change in total revenue divided by the change in total product. If we go from 0 to 5 units of product, our total revenue goes from 0 to 1,000. We take the change in total revenue, which is 1,000, divide it by the change in total product, which is 5, and we get 200. If we go from 5 to 9 units of total product, our total revenue goes from 1,000 to 1,710. Change in total revenue is 710, divided by the change in total product, which is 4. 710 divided by 4 is 177.5, so on and so forth. To get marginal revenue product, same formula. We take the marginal revenue and multiply it by the marginal product. Marginal revenue, 200 times marginal product of 5. So that first worker adds 1,000 to our marginal revenue product. The second worker, we take the marginal product of 4, multiply it by a marginal revenue of 177.5. 4 times 177.5 is 710, so on and so forth. Value of marginal product is, just as before, price times marginal product. Remember, the only difference between these two is, do you use marginal revenue to calculate, or do you use price? For value of marginal product, we use price. So we take the marginal product of the first worker, let's say 5, but we multiply it by the price of 200, which is 1,000. For the second worker, we take the marginal product of 4, but we multiply it by price, which is 190. 4 times 190 is 760, so on and so forth. All right, the calculations are pretty straightforward. Now we use the same analysis as we did for a perfectly competitive firm. Hire workers as long as the marginal revenue product is greater than or equal to the marginal wage cost. Let's do that. Let's say the wage in the marketplace is currently $300. As a firm with this schedule here, would you want to employ that worker? Or how many would you want to employ if so? Would you want to hire the first worker? Well, that first worker would add $1,000 to your marginal revenue product. Therefore, if you only have to pay $300 to employ them, they are employable. The second worker adds $710 to your marginal revenue product. Paying $300 for them is a good deal. You will employ them. The third worker adds $450. Similarly, you would employ them. You would not, however, employ the fourth worker, because they would only add $220 to your revenue, but they would cost you $300. So based on a market wage of $300, you will stop hiring at the third worker. This value of marginal product is different than marginal revenue product. Remember, value of marginal product looks at the price of the good times its marginal product, rather than the marginal revenue times its marginal product. This is the way the firm values the worker's output. This is the way society values a worker's output. The price is the willingness to pay for the product, and that's determined by the buyers of that product. So you'll notice, based on our calculations here, that after the first worker, the value of marginal product goes down, but not as much as the marginal revenue product. In fact, it's higher than the marginal revenue product at every level except the first. So what would society say we should do? Well, if the wage is $300, you would, as society, want to hire the first worker, the second worker, the third worker, and the fourth worker. Note that here, society, consumers would say, this worker is valuable. This worker, this fourth worker, adds $340 in value to consumers. You take what they produce of 2 units of the good and multiply it by the price that people pay for it, $170, and you get $340. So they're adding value in excess of what they cost to produce it, $300. But the firm, if you recall, did not choose that level. They didn't choose 4 workers, they chose 3. Meaning that it is in this example that we start to see the desires of society differ from that of